Lian. I'd like to call our final mini panel of the morning. Our moderator, Jørgen, and our speakers, Robert and the return of Jeff. I'm going that way. No, you can't. Head of Shipping Equity Research at DNB Markets. You might not know, he's a former biathlon coach. I got you, all right. And customer consultant at Santander Consumer Bank. Most recently, before his current position, he was a senior equity analyst for responsible for DNB Markets clean tech and renewables coverage. So Jørgen, we're glad to have you here, and let's grab your panelists, and you can 3 seats, whichever ones you pick there.
Hello. Thank you for the introduction, Mike. Waiting for the panelists to join.
Yep, I'll go look in the hallway.
There you are, Robert. Good to see you.
Robert, take my tie off now?
You should do.
Yeah.
Good. Hi. Good to see you. 2 seats, I think. All right. Good. All right. So let's get started. This is the crude tanker panel, or the tanker panel. I'm sorry, in general terms. And
You can leave. They gave me number 1.
So does the sound work on them? Just to check.
Hello?
Yes, good.
Yeah, I've already put them to sleep an hour ago.
Yeah. Well, let's pick them up then. Pleasure to have you both here with us today. We have Jeffrey Pribor which is the Senior Vice President and CFO in International Seaways. Welcome. And also Robert Bugbee, Director and President at Scorpio Tankers. With that, we can start a bit, I think, to discuss the market and what's been going on before we look ahead. And I think the tanker market in general has been perhaps one of the most anticipated recoveries post-pandemic that people have been waiting for. What we've seen is that there have been several, call it false starts, when you look at the equity markets and how things have picked up at times. Whenever there has been a sign of things starting to improve, people have been willing to jump aboard to be a part of this upcycle, perhaps having seen what went on in containers and then dry bulk, and now also gas, with very tight energy markets and the oil demand recovery in motion. But to start off, we can start, I think, with you, Jeff. If we want to try and pinpoint where has sort of the flaw been in that optimism up until now, and why haven't we seen the market pick up anymore yet?
Well, look, let's be clear. The recovery has started. I mean, recovery is not a very exciting word. Recovery is just getting out of the hospital, right? So that's nothing. That's not running laps or going to a party. It's just getting out of the hospital and getting home. So there's no question to me that Q4 is recovery, right? The rates have been going up, and surely want to hear what Robert has to say. The rates have been going up in every sector since September, right? They're grinding their way up as we expected them to. So really, the question is not about when's the recovery. We've got a recovery. The question is when's the rally, and I think the rally is next year. So, and that's only a month and a half away.
Yeah, I think we have to look at where the bottom was. I mean, Scorpio Tankers is up 100% in 52 weeks. It's up 65% year to date. I mean, so I would say that in your account, the stock itself is recovering. Now, of course, it's doing what you would have in a situation like this. It's a very bumpy position where it's making higher lows, higher highs, but then the drops are very steep, very volatile. And there's a lot of pent-up, I would say frustration because of what you're saying. You've seen the containers, you've seen the dry, you're seeing the gas. But I think we have to remember that in the tanker market is that we're not post-pandemic yet in the tanker market. We're still coming out of the pandemic. We're not yet, only just this last week or so, having transatlantic flights. We just got Australasia open, we just got South America coming. So, and we've just been in our third quarter, which is generally a lousy quarter anyway. But if we were to look at it, the reality, rates right now are actually a little bit ahead. I mean, to have LR2s at 25,000 a day before Thanksgiving is kind of pretty cool. To have MRs in the mid-teens before Thanksgiving is pretty cool. It's even cooler if you look at the inventory draws that have been going on, and the fact that October was one of the warmest Octobers on record. So those are all very encouraging things. And I think also there's a frustration, certainly from my behalf, because it's kind of, wow, you really want to get into this race and get going, because we've got, I mean, this is going to make 1985 to 1990 seem, like a kindergarten, which was the biggest rally we had in tankers. That made 2003 to 2008, which probably most of you guys can reference, look tiny. Because there is what no analyst is doing, if anyone would say what's the missing thing in tankers, is we're all looking at demand, because that's the easy one. When are we going to drive? When's it going to get cold? When's it whatever? And meanwhile, the whole world is kind of oblivious to the supply side. That supply, we've got the lowest tanker book, there is on history. You can't order tankers for way out down the curve, and you've got lots of regulations coming. So when this comes, unlike dry containers and gas, it's really difficult to get a supply response quickly.
Yeah, I definitely agree we're headed in the right direction. But my view would be that the trough perhaps was even deeper than first anticipated, just considering the anticipation again going into this winter. But you say at the moment that the rates has things started, because the follow-up question would be for us investors to look at one specific thing that marks sort of the time when the market really starts to pick up in a fundamental fashion and not only a shorter blip. What would that be, and is that happening now?
Well, look, one thing that I find that is easy to forget if you're on the investing side, not living in the tanker world, is that when we talk about demand, just typically say demand, and oftentimes people think, oh, we're talking about demand for the commodity that gets moved, or the product, commodity in case of crude, or product in case of refined products that gets moved, where what moves rates is demand for the vessels that move, right? And those are correlated, but the delta between them that doesn't correlate all the time is, of course, inventory. So last year, demand was down, but for crude and for products, obviously, as the pandemic set in, but demand for tankers was sky high. And we printed money and we put our balance sheets in good shape to be ready for what was obvious to us would be what happens in 2021, which is as demand is recovering, the demand for transport won't be there until inventories are right sized. And everyone says, well, we're lower than 5-year average inventory. So what? I mean, what's 5 years? I mean, that includes last year, which was too high, and 2016 when OPEC was flooding the market with oil to drive out shale producers. So that's not the right criteria. And you know who knows that? I think the guys at OPEC know that, right? That's why they're not getting more than 400,000 barrels, because they say we need inventories to be down a little lower. And they probably have someone in China they can talk to and ask what the inventories are in China. I don't, you don't, so we don't know what the inventories are in China. So we just had to wait a little longer until those inventories are right sized, because the demand is back, and once the inventories are right sized, then you get to have the benefit of the supply being short, as Robert said. It'll kick off a very long.
I think there's some pretty objective signs right now that the rates are stronger across the board than they were 4 or 5 weeks ago. That we've seen a very steady progression. Sorry, we've seen the rates are stronger than 4 or 5 weeks ago. We've seen a very steady progression of rate profile. That it really does matter that LR2s have moved above 20,000, that Aframaxes are up there in those high teens. On a historical basis, you can go back and look at this period. You then go and look at what I would call our elders and betters, the guys who really look at things, which is the traders. They've been taking on more tonnage in the last 3-4 a bottom. Whether the market fades next week out of inactivity for Thanksgiving or whether it goes up, to me is pretty irrelevant on these little weeks. If we just look at the blocks of months, that's important. Now, what we don't know is whether we get some crazy, COVID lockdown somewhere for a month or two.
Yeah. But as again, we're entering winter is the stronger time of the year for tankers. What about the seasonality and perspectives on that going into a new year again? And traditionally seeing things taper off in terms of tanker demand into the summer?
Well, that they have in good markets gone through. If we go back into the 2000s, the tapering off really doesn't happen much before June. There's a little bit in refinery turnaround, and then the markets can be very strong all the way through till June, and they only taper off in the July, August, September period. And as Jeff said, it's a lot to do with inventories and how things are happening at that point.
Yeah, exactly. But is that the savior potentially that can make sure that once you get past New Year's?
Well, I think it's different things. In the product market, you don't need a savior by season because, when we get into the new year, it's this steady tick of New Zealand closing their biggest refinery for crude and then having to import product tankers on probably the longest ton-mile route that you can have. I mean, if one refinery in Australia added 2% of seaborne product demand, that refinery in New Zealand is going to probably add 3%. So when you have these refinery changes that are going on in the product market, you're really going to have demand growth almost regardless of the season, except for the very slow period, August, September.
But specific to this year, in addition to what Robert's saying, you do have the very high price of natural gas in Europe, which is very likely to lead to substitution of liquid fossil fuels, heating oil or diesel or other sources for electricity in Japan and elsewhere that we haven't seen yet. It's a form of seasonality, but that's why there's so many facilities, for example, in Japan that have the ability to switch back and forth. They used to do it all the time. They've done it less lately because gas has been consistently available, but you could have as much as 1 million barrels a day extra demand for crude and then partially refined crude to fill that gap. So,
and in products, the vessels that are under 15 carrying the premium cargoes, you almost certainly could have a supply decline next year.
And it's again, I thought that the inventory argument is quite interesting. Maybe more so for crude, as you point out, but that could counter a lot of that seasonality if you start to see those inventories inch up again, and that's exactly the point why maybe now is this time it's the time to get on board. I imagine. So,
but I can understand if you look at it from the investor's point of view. This kind of the upside is so hard that what investors are thinking right now, and I can have a lot of sympathy with this, is that they're saying, show me the rate increase, show me that we're past COVID, because, I'm pretty sure these stocks are going to triple or quadruple once they move. So I'm happy to miss the first 20%. That's what a really experienced, some of the experienced tanker and energy investors are thinking is, I know that they're not stopping double because of the dynamics involved, that over 3-4 years they're going to just rip from where they are now. What's important is that I'm buying them, on the up and adding to strength. Partly also because of people's compliance. People can't stand the volatility. They hate the idea of buying a stock and it's down 10% within 30 days.
Yeah, but let's face it, Robert, as much as you and I are saying with a high degree of confidence that it's factual that rates have started up, and it is factual, and share prices. And you know, they go fits and starts, but it's just a fact. It's not a debate.
I'm going to tell you a story that gives me great hope, and this is probably the most subjective indicator, but the most accurate indicator of where we are. And in 2000 and I can't remember, it was 2002, I think, and all our tanker stocks were just smashed to pieces at this point. And, you know, we were suffering from September the 11th, and you know, OMI and a bunch of other companies were just trying to hold on. And I was at this wonderful conference held by Goldman Sachs down in Florida at the time, and the room that I was presenting to was, I don't know, it was a tiny little room in a hotel about a quarter of the size of this, and you know you're in trouble. And there were, in the room were two old ladies who came in for the free cakes and things, who were probably staying at the hotel, and then there were 5 of the youngest people in Goldman Sachs who were on the sales force sitting somewhere near the front, and then there were 3 of the girls who were doing the arrangements too, who were sitting there. And they all had their Goldman Sachs little tags on, so I knew they weren't really investors. And there was one guy who was in his late 70s sitting in the corner, and I sort of presented, no questions, left, went into a breakout room. And you know, you could see the doors of the way to breakout room. There were all these other big oil companies and other energy companies with rooms full. And there was us, me sitting in this breakout room that was bigger than the presentation room, and there was nobody. And I sat there for 10 minutes and I thought, what the hell, I'll just read, I'm not doing anything else. It's quiet here at least. I don't know anybody down here, and fine. And then all of a sudden this 79-year-old guy or 80-year-old guy came in and sat in front of me. He said, that was a wonderful presentation. I said, great, and I thought, oh, this is all I need. I don't need some crackhead guy at this age who's losing his mind just doing this. And he went through and he said, this is great, I like this. He said, I'm buying the stock, I'm buying it now. And I'm going to buy as much of it as I can. I'm going, okay. And he said, do you want to ask me why I'm buying your stock? I said, no, okay, why are you buying your stock? You know, why are you buying my stock? And he said, well, the room's empty. No one's interested. So I said, okay, fine. Didn't think much of it at the time. And then in 2007, November, you know, the stock has gone up 15 times. You know, frontline screaming. This is the famous time when Goldman Sachs are having a conference of 670 people were in the room. And investors were sitting in the aisles. And Torolov and I were presenting. And I was sitting there saying, Suezmax rates, I think this winter are going to go to 75. And Torolov would go, Robert, you've always been so conservative, they're going to 150, you know. And OMI was up another 15, and Frontline was up another 30, just through the conference. I was standing outside with Torolov, we're having a break, tap on my shoulder, and there's this old man in front of me.
Now he's 84.
Yeah, exactly. Right? He's got a cane now, right? He's got less hair than I have. And he's standing there, he looks at me, do you remember me? And I said, yes. And he looked at me and he goes, it's time to go. The room is full, it's time to go. And then he just walked off. Well, the reason this is important is because Scorpio Tankers gave its earnings release last week. In the history of the company, we had less people dialed into that earnings conference. We didn't even have the analysts who hate us, like Ahmed Malhotra from Deutsche Bank. Even he'd given up hating us. He was you weren't on, right? You were probably in some party somewhere in Norway, celebrating something or other. But
I was on.
Were you on?
He covers you?
You were too bored to ask a question. And there was the lowest number of people there. The lowest number of people have dialed in. We've only had 2 investors who've asked for a one-on-one meetings and things. So this is my sign that we are absolutely just passing the bottom right now. As we speak.
And what about today's crowd?
They haven't bought anything yet, really.
Okay, and to you, Jeff. I just to cover the 2 segments, because International Seaways is dabbling in both, of course. And I'm just curious, if you had to choose crude or product, which one would you opt for?
I can't believe you're asking us that question. I mean, what's he gonna say? You know?
No, exactly.
And you know what I'm gonna say, I love them both. I mean, they correlate. And there's no question they correlate. They correlate because we know that whether it's demand we transport the world, right? It's gasoline, diesel, jet fuel, yeah, and it's a little bit of intermediate products that make plastics. And that has to start as crude and it ends up as refined product. It's going to be on one ship, but then it's going to be on another, and in between is a refinery. And in the middle of the vessel classes, you can switch back and forth. So it's obvious that they correlate, and you can have your theories, but we like being diversified. We've always liked being diversified. We were at OSG, we were in the beginning of the days at International Seaways, and we're very happy to take up 50 MRs along with 13 Suezmax when we merged with Diamond S.
Yeah, I mean, just to clarify, I'm very sure that some people are here for us, and that's very flattering. Most people are here, I think, it's the first virtual meet, so it's a good thing to come to on an expense trip and get out and travel. So, but that's okay. But it's pretty. I agree with Jeff that product and crude correlate. They're just correlating less in the future and the present, and the products will trade better on value because of the dynamic of the refinery changes. But at the same time, it's very clear that the crude is going to go up too, and all companies, even a pure play crude company and a pure play product tanker company, are almost certainly going to trade in parallel over the coming months.
Okay. So as rates pick up and markets improve, cash starts to come in. Looking at allocation of that cash going forward, you have a very low new building order book, as you mentioned. Is that an opportunity do you see any opportunity in growing the fleet and renewing the fleet as things stand now, or is it time to harvest and return to shareholders, which would be the priority, given that outlook, which is quite stellar if you look at the supply side?
Well, we are the really new fleet. So we don't have to do any renewals to do anything. We've got a very young fleet. I'm trying actually, and this is a serious comment, very serious comment, is I'm trying to intellectually get my head around why anyone would want to buy a tanker for a delivery much past 2005-6, and even 2005 or 6. I'm trying to intellectually work out why you would do that. Because you can definitely see that the returns are going to be extraordinary through till maybe 2007, 2027. But you are at some point towards the latter half of the decade going to have the demand side dramatically slow down and the ton miles probably go down. Now I think right now, I think that these, the ideas of renewables replacing the conventional oil, etc., is a little bit optimistic that it's going to happen fairly early, because when we look at our renewables investments, almost everything is coming later than what the people think it will come, or the pro-renewables think it will come. And but I can't see when you've got a 25-year life or whatever, quite yet why one would order tankers.
Yeah, I mean, Robert, you've got a modern fleet, and that's great. So you're ready. Look, the answer to your question, from my perspective, is if you're saying, "Oh, the cash is finally about to come," are you about to invest in tankers? If you waited that long, you've waited too long. The time to move was last year, or the beginning of this year. As you can tell now, values are up. Clearly, values of ships are up. And you can say it's just steel prices on one end of the curve or another, but it's more than that. And rates are at a low but coming up, and they're dislocated. And it's one of two things is going to happen. Either values are going to come back down, or, as Robert and I have told you, that rates are going to come up to meet the values. And if you didn't buy tankers ahead of that to get ready for it, then you missed it. You better wait for the next cycle. You missed it. We spent $400 million in stock and consumed some cash to buy $1.5 billion of assets of tankers in our stock deal for Diamond S. So that was our move. People say to me now, "Oh, you just merged with Diamond S, you have an older fleet. Well, what are you going to do to fleet renew?" Are you kidding me? We was 5 million tons, deadweight tons last year, 10 million deadweight tons now. you know what I would do to take my age down a half a year? Well, I'll sell a few ships, which is what we're doing. So I don't need to buy any more tankers. He's got a month. He doesn't need to buy any more tankers. It's time to harvest the cash that's going to come with this market that, you know, we're professional optimists, so it's totally, you're right. It's show me the investors are they're not going to invest because we had this talk and read money. You guys aren't going to invest enough. Maybe you will. I hope you do. But you know, it's going to come, and then we'll get the cash, and then we'll make the right decisions what to do with it. But if you wait until now to buy tankers, you waited too long.
Yeah. So, but what about the benefits of scale? Is that anything that comes into consideration when it comes to the transaction that you did? I believe, you know, you went towards being more oriented to the crude to being a diversified play. What's your thinking and the strategic decision behind that? Is that anything you believe? What was the purpose in terms of driving up? Is it liquidity or is it?
The benefit of scale. There are some benefits. We have cost synergies that are not insignificant. So our G&A per ship and our OPEX per ship is going to go down. Through 2022 over $20 million. We've said that, and that will happen. So that's a plus. But the other primary benefit of scale is getting to a size, and it's not so much a magic number of $1 billion or whatever, but it's more the trading liquidity that comes with that, such that you can be the choice that a portfolio manager, especially a portfolio manager of a long-only fund, who's going to possibly stick with you through cycles and not just trade in and trade out. But you want to be in the conversation. You know, first, if there's going to be a wave, if there's no wave, it doesn't matter. No one's going to be investing in you while the water's placid. If there's a wave coming, like Robert and I are saying, you know, I need to be in front of every portfolio manager I can, or the analyst who's recommending on the buy side or sell side who's recommending that portfolio manager. If you're going to play tankers, you have to think about, you know, international Seaways, whether it's crude or product. There's no doubt if you're thinking about product tankers, you're looking at Scorpio. You have to, right? But I need to be in that same conversation with them. Lois does with me about Seaways, so that when they make a choice, it's not just frontline. Well, that's a JF, you know, vehicle. It's not just Suriname. It's not just DHC, but you should be looking at Seaways. Oh, and by the way, it's cheap. And by the way, it's now $1 billion in trading, you know, $15 million a day, which is not yet, but it will be, right? So that's the benefit of scale from our perspective. But it starts with the scale, then the hard work to tell people where you are.
Yeah. And then if we want to raise our eyes a bit finally, and as you talked about, the potential of a declining demand scenario down the road, I think it's an interesting thought, and I don't know if you have any input on that, but historically, is in a declining demand scenario, is that something that has any historic events in shipping where you've seen that happen? Because I guess what drives the upcycle in shipping is the disconnect between the wanting of supply at the time when it takes 3 years to order a vessel. How will that dynamic potentially change at that point in time when oil demand has peaked?
Well, what should happen is that the investment for new buildings or for the supply side should slow down further as a result of that thought, that people will second guess. They have 2 reasons to worry. They'll make a pause. What engine do you need, and whether you should invest. And as you get further and further out that curve, there'll be less, you know, speculative new buildings. It'll be harder to raise finance for a speculative new building order. So that should slow the replacement down. That by itself, because we certainly don't have the energy in place right now, will keep the fleet flatter. So we'll actually create some pretty extraordinary returns. With a fleet that's actually on the water at the time.
Look, it's not a mystery. This has been happened in other industries over time. We know what to do in a declining sector. If revenue of the sector is declining, well, then that's another benefit of scale. You know, if you're going to grow or even stay the same in a declining sector, there's only one way to do it: is to pick up market share. If you're not, you're shrinking, right? So who's going to pick up market share? The small ones or the big ones, right? No, it's going to be Scorpio and Seaways and a couple of others that will be playing in that market for a long, long time at a higher margin, because inevitably what Robert's saying will happen. You know, and they'll probably build too few ships, and so the ones that those of us at the top of the leaderboard, you know, will be experiencing a pretty nice margin.
You're seeing rapid consolidation right now. in the product side. The pooling that's going on, if you look at, if you took Torm, ourselves, Norden, and Hafnia, underneath the scenes, I mean, there are double-figure ships a week that are going into these pools right now.
Right, and don't forget something else. I see we're short on time, but yes, there'll be a point when the core business that Sing and Seaways are in that today has a declining nature to the top line. There's no question about it. We'll manage that like we just talked about. But the opportunity for moving alternative fuels, is immense. It's so exciting. And if you, I'm sure you thought of this, Robert. Almost everything that's going to fuel airplanes, cars, trucks, etc., it's going to take up more volume than the most efficient but highest polluting stuff we move around now, which is gasoline and diesel and crude. So we're going to need more ships. I mean, it's going to be really exciting. Now, that's a few years out, but we're going to have two strategies. Or three. We have manage the existing fleet at a declining market. We have a transition strategy for gas because we think it has a really important role to play for this decade. And then I'm really excited about what we're going to do to take our expertise or experience, hopefully expertise, and apply it to moving something new.
Alternative liquid fuels.
Yes.
Yeah.
Maybe, but I mean, I think that comes later. What happens now?
It's a bit out.
Yeah, back to the beginning. The recovery has started. The rally is next year. So let's start with that.
That's too.
I think I think we'll leave it at that.
Yeah.
And a pleasure to hear your input both. Thanks for taking the time.
Yeah, I'll look for you on my next conference call.
Yeah, thanks Marine Money for holding with us. Thank you very much.